Welcome to mutual fund investing in India. Aligning investments with financial goals is crucial. This checklist will guide you through informed decision making, ensuring your investments align with your objectives. Let's explore how to define your financial goals, set smart objectives, and match them with the right mutual fund types for effective investing. Identify your financial objectives: short term for emergencies or vacations, medium term for a house down payment, and long term for retirement. Set SMART goals: specific, measurable, achievable, relevant, and time bound. Align your investment horizon with the mutual fund type, such as liquid funds for short term and equity funds for long term goals. Assess your risk appetite by determining if you have a low, moderate, or high risk tolerance. Utilize risk assessment tools for precise profiling. Consider your age and income to gauge risk capacity. Younger investors or those with stable income can afford higher risks, while older investors may prefer conservative options. Explore mutual fund categories to align with your risk profile. Equity funds offer high returns for long term goals, while debt funds provide stability for short term needs. Hybrid funds balance risk and return. Choose large cap for stability, mid cap for growth, or small cap for high risk. Consider sectoral funds for specific industries and index funds for low cost diversification. Evaluate past performance by comparing returns over 1, 3, 5, and 10 years against benchmarks and peers. Check expense ratios for cost efficiency, as lower ratios increase net returns. Research the fund manager's track record and assets under management for stability. These factors ensure informed decisions aligning with your financial goals. Choose between direct and regular plans. Direct plans have lower expense ratios, ideal for self-directed investors. Regular plans include advisor support, suitable for those needing guidance. Opt for direct if confident in managing investments. Choose regular for expert advice. Complete KYC compliance by submitting PAN, Aadhaar, and a photograph. Link your bank account for seamless transactions and ensure net banking is enabled. Assign a nominee to secure your investments. This step is crucial for a smooth investment process and safeguarding your financial interests. Choose your investment mode wisely. Systematic investment plans offer disciplined investing and rupee cost averaging, ideal for salaried individuals. Lump sum investments suit windfalls or undervalued markets but carry higher risk. Consider systematic transfer plans to spread investments and systematic withdrawal plans for regular income. Each mode aligns differently with your financial goals and market conditions. Select a platform for investment by considering AMC websites, online platforms, or DMAT accounts. Prioritize a user-friendly interface and robust customer support. Evaluate features like portfolio analytics and tax statements to ensure they meet your needs. This choice will streamline your investment process and enhance your overall experience. Understand taxation for equity and debt-oriented funds. Equity funds have 15% tax on short-term gains and 10% on long-term gains above Rs 1 lakh. Debt funds are taxed as per income slab for short-term and 20% with indexation for long-term. Tax-saving funds offer Section 80C deduction. Monitor tax law changes for compliance. Regularly monitor and rebalance your portfolio to align with financial goals. Avoid overtrading. Stick to long-term plans. Plan an exit strategy, considering exit loads and tax implications. This ensures your investments remain on track and adapt to market changes, securing your financial future. Avoid common pitfalls by not chasing returns and acknowledging risk. Limit fund selection to prevent over-diversification. Ensure Know Your Customer is complete to avoid transaction issues. These steps help maintain a balanced and effective investment strategy, aligning with your financial goals. Leverage regulatory safeguards to ensure transparency in your mutual fund investments. Verify fund compliance with Securities and Exchange Board of India and Association of Mutual Funds in India standards. Utilize grievance redressal platforms like Securities and Exchange Board of India's SEBI complaints redress system for any complaints. This ensures your investments are protected and aligned with regulatory norms, providing peace of mind as you navigate the mutual fund landscape. Plan for contingencies by maintaining an emergency fund covering 6 to 12 months of expenses. Ensure adequate health and life insurance to safeguard your financial plan. Regularly update nominee details as personal circumstances change, such as marriage or childbirth, to ensure seamless transfer of investments. Seek professional advice if needed. Consult certified financial planners or use robo-advisors for guidance. Be cautious of mis-selling by distributors who may push high commission plans. Ensure your investment choices align with your financial goals and risk tolerance, leveraging expert insights to make informed decisions. Stay informed on market trends and fund updates. Monitor scheme changes and tax law revisions. Keep abreast of financial news for real-time updates. This ensures your investments remain aligned with your financial goals and adapt to any regulatory changes, enhancing your decision-making process. Example portfolio allocations cater to different risk profiles. Conservative investors might allocate 60% to liquid funds, 30% to corporate bonds, and 10% to large cap equities. Moderate investors could choose 40% large cap, 30% aggressive hybrid, and 30% short term debt. Aggressive investors may opt for 50% mid small cap, 30% large cap, and 20% international funds. Making informed mutual fund investment decisions is crucial. Start small, diversify wisely, and regularly review your portfolio to stay aligned with your financial goals. This approach ensures you minimize risks and maximize returns, paving the way for a secure financial future.